Good morning, namaskar and welcome to the course once again. In the last lecture, we discussed break-even analysis for linear problems. When I say linear, it was essentially meant to be like this. Whatever be the quantity that we are producing or we are selling, it was independent of the prices. That means, if we are selling the quantity X at P price, we will sell that quantity 2x also for the same price P only. We also made some other assumptions. For example, we made assumption that the company is into only one product. Later, of course, we released that assumption. We said that company is into multiple product also, and we could see how multiple break-even analysis can be done. One of the other assumptions was whatever quantity is being produced is being sold. Now, in this lecture, we are going to cover non-linear break-even analysis. Now, as the name suggests, here the relation between price and the quantity, the cost and the quantity is not linear. Rather, they are following some non-linear relationship. So, how to carry out the break-even analysis under such situation, that is what we are going to discuss in this particular lecture. Now, we will straight away move with one small example, so that it becomes clear to you how to perform the break-even analysis. So, let us assume that a firm is considering manufacturing a new product and these data are available to us. The sales price is $12.5 per unit, the equipment cost is $200,000, overhead cost is $50,000 per year, operating and maintenance cost is $25 per operating hour, production time is of course 100 hours for 1000 unit, and planning horizon is 5 years. The rate of return is 15%. We are supposed to determine the sales volume that would make manufacturing this product profitable. You are given this factor also, P given a 15%, 5 is equal to 3.352. Now, this is the kind of problems we will be encountering in nonlinear break-even analysis. What you are finding is that depending on the production, your prices are changing, your sales price is changing, your cost is changing, unlike the linear analysis where these were supposed to be constant. Now, in nonlinear break-even analysis, we come across two types of problems. In one problem, we are given the data corresponding to, let us say, the data could be something like this, wherein we are given the indirect cost, we are given the direct cost and we are given the total cost for different level of production. So, for different value of n, that is production level, we are given what is the indirect cost. For example, for 0 production, that means no production at all, we are incurring an indirect cost of 3000, the direct cost is 0, total cost is 3000. If the company is producing 1 unit, indirect cost remains same. In fact, irrespective of your production, your indirect cost is a constant. On the other hand, direct cost is changing with respect to the level of production. So, for example, 1 unit production, the direct cost is 700, 2 units it is coming out to be 1300, 3 units it is coming out to be 1800, 4 units it is 2400 and so on. You find that if the company is producing 9 units, the direct cost is 7800. So, total cost, as you know, is the sum of indirect cost and direct cost. So, here for no production it becomes 3000, for 1 unit it becomes 3000 plus 700. So, 3700, for 2 units 3000 plus 1300 it is 4300 and so on. So, this is one set of problem in which we are given the hard data corresponding to different production level. So, we are given the indirect cost, we are given the direct cost and we are given the total cost also. Now, looking at these data, we can derive a relationship between cost and the level of production. Likewise, you can also have data pertaining to purchase price with respect to production level, and we can try to find certain equations, we can try to fit in certain equations which can explain the relationship given by these data. So, this could be one type of problem. On the other hand, the other type of problem could be in which we are directly given the equation. For example, it could be that okay, my purchase price or sales price rather is given in terms of A minus B into Q. Q is the quantity that we are producing, A and B are constant. So, these values will be known to us in the problem, and let us say the relationship is given. Likewise, they will tell you okay, the total cost is fixed cost plus variable cost. So, FC plus VQ. So, let us say V is unit variable cost and Q is the quantity. So, total variable cost becomes VQ. So, the idea is in some cases we will be directly given these kind of equations to establish the relationship between, let us say, sales price versus quantity, cost versus quantity, and so on. Now, knowing these cost and the price, we can always find what is the profit or what is the saving that we are getting. So, let us say if S represents saving, so the difference of price and cost, the revenue and cost is going to give me the saving. Now, what I do is at the break even point, as you know, the cost and the price both are going to be the same. That means, it is that particular production level at which we are just able to recover our cost. You have already seen how to find out this break even point in case of linear break even analysis. Now, with the help of one small example, we will see how to find out the break even point. As the relationship is non-linear, sometimes you might find that break even point could be more than one. So, we may have to find out what is the level of production that we should go in for, so that it results in maximum profit. So, we are adding one more dimension. So, if you know the principle of calculus, you should be in a position to find out that production level at which you are able to maximize your profit. Now, we will try to explain this concept with the help of one small example, wherein I give you the relationship of various variables in the form of an equation, and then from there onwards you can see how to carry out the break even analysis. So, let us assume we are given for a particular product, the sales price is given to be 21,000 divided by under root 1. So, that means the relationship between the quantity sold and the price that you are charging is captured by this equation. We are also given the direct cost as let us say $1,000. Let us say the indirect cost is given to be 100,000 for a particular period. So, we say it is per period. So, these are the input. Now, I define two terms, we call them as marginal revenue and there is another term called marginal cost. So, these two definitions also need to be understood and then subsequently we will see how to carry out the break even analysis. So, when you say marginal cost, it is basically the additional cost that we are incurring to produce one extra unit of product. This is how you define the marginal cost. So, what is the additional expense that you are incurring in order to produce one extra unit? Now, to understand this concept of marginal cost, just look at this example. Let us say the cost to produce 100 cubic meter of concrete is rupees 200,000 and the cost to produce 101 cubic meter of concrete is let us say rupees 201,000. So, we say that the marginal cost at this level is 201,000 minus 200,000. So, this is the extra that we are incurring for producing what? From 100 to 101. So, that means if right now you are producing 100 unit, your cost is 200,000 and if you are producing 101 cubic meter, your cost is coming to be 201,000. So, what you find? The marginal cost here is 1,000 rupees. So, marginal cost is that extra cost that you incur in order to produce one more unit. In the same manner, you also define marginal revenue. So, marginal revenue in the same manner you can define it as the additional money which you realize by selling one extra unit of product. So, suppose right now you are selling 100 cubic meter of concrete for a price of let us say 250,000, and by selling 101 cubic meter of concrete you are realizing 250,000. So, what is your marginal revenue? Your marginal revenue becomes 252,000 minus 250,000 divided by 101 minus 100. So, when you were selling 100 you were getting 250,000, when you were selling 101 you were getting 252,000. So, what is your marginal revenue? It is 2,000 rupees. So, basically this is how you define marginal revenue and marginal cost. Now, we go back to the problem which we are trying to solve, and in this problem if you remember I told you that P is given by an expression of 21,000 divided by under root n, and direct cost is given to be $1,000, the indirect cost is $100,000 per period, right. Now, marginal revenue is defined as d by dn of this revenue r, where r is what? R is n times P. So, n is the number of units we are producing and P is the sales price. So, revenue that you will get is n times P. Suppose n is 10 units and P per sales price is 1000 rupees. So, 10,000 rupees would be your revenue. So, marginal revenue is dr upon dn. So, first we try to find out what is going to be the marginal revenue for this problem. So, you are already given P and you know R. So, R becomes n times P and n multiplied by P is 21,000 divided by under root n. So, this gets cancelled and you are getting a value of 21,000 root n. So, this is your R. Now, we have to differentiate it with respect to n. So, I say okay dr upon dn, which is d of np upon dn. This is nothing but 21,000, and for root n if you remember from your class 12th calculus it is 2 by root n. So, this gets cancelled. So, this is 10,500. So, this is coming out to be 10,500 upon under root n. So, this is the marginal revenue that we are getting. Now, my profit is represented by Z. Z is nothing but my revenue minus total cost TC. Revenue is nothing but n times P and TC is nothing but n times UDC plus indirect cost, which is IC. So, all these terms you are already familiar with from the previous lecture. Now, what I do is I just try to simplify this and you will find that you are getting an expression like this. Z is 21,000 under root n minus 1,000 n minus 100,000. This 100,000 is the indirect cost which is given for that particular period. Now, at break even you know Z becomes 0 because you are not able to make profit at break even point. So, at break even point Z is equal to 0. So, you equate this expression to 0, and when you do this you will find you are getting a quadratic equation, and this is how it looks: n square minus 241 n plus 10 raised to power 4, this is equal to 0. So, this is the quadratic equation we are getting. When you simplify this and when you solve this you will get a value of n as 188 or 54. We have got these values. After rounding it off you can cross check these calculations. So, as I told you just before this solving of problem that there could be multiple values of break even points. So, these are the break even points. That means, whether you produce 188 or you are producing 54, you are able to recover your cost. So, at these two values you are neither making any profit nor making any losses. Now, another problem that we have to find in such problems is to find out that particular production level at which my profit is maximum. So, you know the concept of calculus, you have to differentiate Z with respect to n in order to find the maximum value. So, dz upon dn we can calculate. Now, Z you already know it is 21,000 under root n minus 1000 n minus 100,000 d by dn of this expression. Now, I equate it to 0. From the knowledge of calculus, you know, I have to first find the derivative of this and equate it to 0, and when I solve it I get n is equal to 110. Now, this 110 is that production level at which my my profit is maximum. So, if you remember, we had two values of break even point, that was 188 or 54. Now, in between these two value I find there is one value of production 110 at which my profit is maximum. So, this is how you have to calculate your break even point, and you also have to find out that particular production level at which the profit is maximum. Now, we will take one more example, and that will reinforce your understanding of break even analysis, and in order to do this I will just tell you what is there in this particular example. I have already explained you the data that is available to us. The sales price, if you see, it is the sales price, it is $12.5 per unit. Equipment cost is 200,000. Here basically we are trying to make a decision between whether to buy a particular equipment or whether continue to outsource the product, right. So, this is what the statement says. Suppose a firm is considering manufacturing a new product, and if they are trying to go for manufacturing, the equipment is costing 200,000, overhead cost is $50,000 per year, operating and maintenance cost is $25 per operating hour, production time per 1000 unit is 100 hours, and planning horizon is 5 years. So, if you try to draw the cash flow diagram for this, let us say basically if let us say we are going in for buying of equipment, it would be like this. The equipment is costing 200,000. So, straight away at time t is equal to 0, we have to spend $200,000. Now, overhead costs are $50,000 again every year, $50,000 per year. This is 1, 2, planning horizon is 5 years as given in this problem. Operating and maintenance cost is $25 per operating hour. Now, the question is determine the sales volume that would make manufacturing this product profitable. So, let us assume I am producing X unit, X unit is being produced, right. Now, it is given that operating and maintenance cost is $25 per operating hour, right. So, it is 25 per hour, right, and it is also given that production time per 1000 unit is 100 hours, right. So, that means 1000 units are produced in 100 hours, 1000 in 100 hours. So, 1 unit I can produce it in 100 by 1000 hours. So, it is 1 by 10 hours. So, X unit I can produce in X by 10 hours. X unit I can produce in X by 10 hours. Okay. Now, I can draw the whole thing on a piece of paper in a cash flow diagram like this. So, if you look at this, the cash flow diagram would be something like this. If you remember, the sales price is 12.5 rupees per unit. So, I am assuming that sales volume be X unit. So, this is going to be 12.5x every year. Why? I am assuming that every year we are selling X unit and price for 1 unit is 12.5. So, 12.5x. Now, we are also given that $25 per operating hour, $25 per operating hour is the O&M cost, operating and maintenance cost, right. And in 1 hour we are producing x by 10. So, our cost is going to be 25x by 10, which is nothing but 5 by 2x. So, this is what we are getting 5 by 2x here, and $50,000 per year, year 1, 2, 3, 4 and 5, and in addition the variable cost is 5 by 2x. and if you are buying the equipment 200,000 you are incurring at time t is equal to 0. Now, there are many ways you can solve this problem. You can either try to equate the present worth of these revenues that you are getting and equate it with the cost that we are getting for this whole thing, and then you can find the value of x. This is how this particular problem has been solved in this particular slide. So, you can see the net present worth becomes minus 200,000, this is for buying option, this is for buying option, minus 200,000 minus 50,000, P given a 15% for 5 years, and you will add this 5 by 2x, P given a 15% 5, and you equate it to this or you bring it here plus 12.5 x, P given a 15% 5. You will find that when you try to solve this, you are getting a value of x is equal to 10,966. The same problem I can solve it also using the annual cost method. So, the same cash flow diagram I will draw once again. So, here we are incurring 200,000 at time t is equal to 0 and 50,000 every year as overhead cost plus 5 by 2 x I am incurring every year. This is being done for 5 years. So, 1, 2, 3, 4 and 5. So, my total cost is going to be 200,000. I want to find its equivalent A. So, I write A given P for an interest rate of 15% for a period 5 years, plus 50,000 is in terms of annual cost itself, plus 5 by 2 x is also in terms of annual cost itself. So, when I solve this, this expression is 200,000 divided by 3.352 plus 50,000 plus 5 by 2 x. So, this is the cost corresponding to buying option. If I am getting it from other place, I am getting it at a rate of 12.5 x. So, what I do? I equate the two. So, 12.5 x is equal to 200,000 divided by 3.352 plus 50,000 plus 5 by 2 x. So, when you solve this, you will get x as equal to 10,966. So, this is how, whether you use annual worth method or whether you use present worth method, you can find out the solution. So, you find that as long as you are producing x is equal to 10,966, whether you buy or whether you produce it through your own equipment, both are going to be the same. If the value of x changes from this value, your decision also changes. Now, I take another problem that will give you more understanding of this break-even analysis. Just look at this particular problem. It says there is a contractor who is experiencing a seasonal pattern of activity for compressors, right. So, compressor is a construction equipment which is very useful at sites. For many purposes it can be used. Now, the manager is currently owning 8 compressors and suspects that this number will not be adequate to meet the demand. So, they already have 8, but they find that this number will not be adequate to meet the demand. The contractor realizes that there will arise situations when more than 8 compressors will be required and is considering purchasing an additional compressor for use during heavy demand periods. So, they want to go beyond 8, so that they can take care during heavy demand periods. Now, the local equipment rental firm will rent these compressors at a cost of $50 per day. Now, as I told you, in using break-even analysis concepts, you can have a decision between purchasing versus renting, buying versus leasing and so on. So, right now you see here local equipment rental firm will rent compressors at a cost of $50 per day. On the other hand, if you want to buy it, it can be purchased for $6,000. Now, the difference in operating and maintenance cost between the owned and the rented compressors is estimated to be $3,000 per year. So, that means between the owned and rented compressor, if you try to find the difference for operating and maintenance cost, you find it is $3,000 per year. Now, letting x denote the number of days a year that more than 8 compressors are required. So, suppose x is the number of days for which more than 8 compressors are required, we are supposed to perform a break even analysis. That means, we are supposed to find out for how many days in a year, if we are going to use more than 8 compressors, buying option would be preferred or renting options would be preferred. You are given that planning horizon is 5 years, salvage value is 0 and there is a 20% minimum attractive rate of return. So, interest rate is 20%. Now, for solving this problem again, we try to draw this cash flow diagram, and if you see, the cash flow diagram would be something like this. As far as this owning option is concerned, compressor you can own it for $6,000 if you have this much money at t is equal to 0, and let us assume that planning horizon is, let us say, 5 years. So, 4 5, and let us assume y1 annually is the operation and maintenance cost for this particular equipment. This is the owning option. Now, there is no salvage value given. So, this is 0 here, salvage value is 0. On the other hand, for renting option, at time t is equal to 0, you do not have to do anything, 50x is given and y2 is given. So, if you remember, on rent these compressors are available for $50 and $50 per day. So, if you are using it for x day, it is 50x, likewise 50x here, 50x here, 50x here, 50x here, and of course, y2 every year as part of O&M cost, and at t is equal to 0 there is nothing. So, this is renting option. Now, I just compare the cost of the two and equate them, because at break even I am indifferent towards owning as well as renting. So, what I do? I just equate the two costs. Now, this I could have done it using present worth method of analysis also, but annualized cost equivalent method would be much easier here. So, what I do? I equate it like this: 6,000 A given P, because I know the present value, I want its annual value, for an interest rate of 20% for 5 years period. This is for owning, plus y1, this must be equal to 50x plus y2. Now, I bring this y2 to this side. So, I write 6,000 and A given P for 20% 5 years, it is going to be this value 1 upon 2.9911 plus y1 minus y2 is equal to 50x. And now, in the problem I am given that y1 minus y2, that is the difference in operating and maintenance costs between owned and rented compressor, is $3,000. So, this is 3,000. So, 6,000 divided by 2.991 is equal to 50 times x. So, if you solve this x, you will get some value 100.12. What does this mean? If I use this compressor for more than 100 days, it is preferable. As long as you are using exactly for 100 days, then whether you buy or whether you take it on rent, it does not matter. But more than 100, buying option would be preferred. If you are using it for less than 100, the renting option would be preferred. So, this is how we try to carry out the break even analysis in case of non-linear situations. So, just to summarize, in non-linear break even analysis, either we are given the data for the number of production, the direct cost, the indirect cost, and from this data I can try to find out some form of equations by fitting some form of curves, and then using the principle of calculus I can find out the break even point. I can also find out that particular point at which the profit is maximum. in another case, I may directly be given the relationship between different variables. Using those variables and the knowledge of calculus, I can find out my break even point. I can also find out at what production level my production is going to be, profit is going to be maximum. So, this is how I carry out my non-linear break even analysis. So, thank you for listening and see you in some other class. Thank you very much.